All right, we are on chapter 8 and we're covering inventories. We'll actually cover inventories for this chapter and the next chapter. Okay, so let's get started. So, inventory for a merchandising business is one of the biggest assets. If you think about all the inventory in every single Walmart warehouse, that is a logistical nightmare to me. But that is where technology helps keep up with that inventory. Okay. Haven't always had computers. So, like when Walmart first started, there was not a perpetual system where they were continually keeping up with inventory. They were using more of a periodic system. Very few businesses use periodic anymore just because technology has advanced so much. But for some reason, the CPA exam still covers periodic inventory. So, we will cover it in this chapter. Okay. Um, when they refer to inventory, they're looking at stuff they are planning on selling in the normal course of business, um, uses currently in production of goods to be sold, could be raw materials. These two right here are going to be more of your cost accounting type things. Remember your raw materials, work in process, and your finished goods. Okay, those are all three inventory counts. Okay. Cost of goods sold is used in a merchandising business and a manufacturing business. Okay. But when cost of goods sold leaves finished goods, it turns into cost of goods sold there. Merchandise inventory, when it leaves that, the inventory leaves the building, it turns into cost of goods sold there. So when it is sold. Okay. So, yay, here they gave us a little brief overview of the inventory. And the inventory, any other cost necessary to get it to the condition and location of the sale. So, that shipping coming into our warehouse, that gets added to the inventory. Okay. Here's our three raw materials, work in process, and finished goods. Um, we talked about this just a little bit in the end of Principles 2. Next fall of 26, we'll have a whole class on cost accounting, and we have some fun things planned for that. So, um, you may remember that I showed you a video of how aluminum foil is made, and we saw the raw materials go onto the assembly line. The working process is in my head like an assembly line. Okay. And then those costs, remember your direct materials, direct labor, manufacturing overhead. Those are the three things that go into work in process. Okay. Then when it's done and it's just sitting in inventory ready to be sold, it's classified as finished goods. Okay. So this is Intel Corporation, and they have a breakdown here of what the raw materials, work in process, and finished goods are. They don't have any merchandise inventory because they are, looks like they're a manufacturing business. Okay. So they're not going to have merchant. Oh, I see why they put that there because they got Best Buy over here. Best Buy has 5140 in merchandise inventory because Best Buy is not the people in the back. They're not in the back room creating those computers. They're buying them from other people. Okay. So this is just the cost flow as it goes through the T accounts. I gave y'all a handout on that in Principles 2. I can add it to this class as well, just to kind of help you see the flow of how everything flows into work in process and then on to finished goods. Okay. All right. So let's talk about perpetual inventory. Perpetual means we are always keeping up with inventory. Every single day, every second of every single day, we know how much inventory we have because every time inventory comes in, we make an entry. Every time inventory goes out, an entry is made as well. Now, that is made those all those entries are very easy because we have those barcoding systems. So Walmart, when you're scanning that item, you're bringing up the sale, but it's also taking it out of inventory. There's other things that happens when that sale is being rung up. One thing in particular, if the inventory levels drop to some kind of predefined level, then a purchase order will be automatically sent to, hey, Pepsi, we need more 2 liters. Send them to us. Okay. Not one person was involved in that. Could you imagine doing perpetual and we didn't have computers? You'd have somebody sitting there making a journal entry every single time somebody you'd have to have teams and teams of accountants checking people out, and it would be a nightmare. So before computers, they used periodic. Okay. They really didn't know how much inventory they had at any given point, except when they counted it at the end of the year. That's the only time they knew how much inventory they had. Okay. So this problem is going to go through the journal entries of the perpetual system. So here we have Lothridge, and it says the company uses perpetual inventory, and it begins the year with inventory of 120,000 on hand. Okay. They said additional soft drink inventory is purchased on account. They sold some, and the cost of the inventory that they sold was 540,000. Okay. Perpetual, we are going to keep up with how much is going in and out of this account. So let's take care of the first one. We're purchasing. We don't do anything with the 120,000 because that was our beginning inventory. It was already there. It was last year's ending, so now it's this year's beginning. So we will debit inventory, credit accounts payable for that $600,000 of inventory. Okay. Then we're going to record a sale of 820,000. They're debiting accounts receivable, crediting sales revenue. Okay. Remember, when it's perpetual and you have a sale, you always have two entries. Okay. You always have two entries. So now we have to record the cost of selling that $820 of goods. So we'll debit cost of goods sold, credit inventory. Okay. So that's our journal entries under a periodic system. I'm sorry, perpetual system. We will do periodic here in just a minute. As I've mentioned, barcode scanners, like the price of them have come down so much. Like, used to Walmart, Target, all those places would have barcode scanners, but like your small stores, little boutiques, gas stations, they still, like, the cost of a barcoding system was still too high and out of reach, but they've come out with some really good ones that are for smaller businesses. So, there's really, I can't even think of a place that you buy anything that they don't scan a barcode to check you out and for you to buy it. So, all businesses are on a perpetual system, which gives us better information, by the way. Okay. Periodic, like I said, we don't even know how much we have until the last day of the year whenever they count everything. That is the only day they know how much inventory they have. Okay. Makes it a little difficult when you're a salesman and you're trying to look in the system like, hey, I need to sell this many cases of butter. How much do we have? We don't know. So, we just sell it and then, hey, let's go see how much butter we have. Okay. So periodic. Now, they give us this little formula down here, beginning inventory plus purchases. This still works under perpetual also. So don't think that it's just specific to periodic, but I've wrote it out like this before. Beginning inventory plus any purchases gives us goods available for sale. Now, we can do this one of two ways. We can subtract the ending inventory and we'll get cost of goods sold. Or we could switch that. We could subtract cost of goods sold and get ending inventory. Okay. So it doesn't really matter if they give us ending inventory, if they give us cost of goods sold, we can back into the other one, no problem. Okay. So that's used in perpetual as well as periodic. Okay. Now let's look at these entries under a periodic system. Okay. Under periodic system, notice they tell us what the physical year-end count is. They didn't tell us what cost of goods sold was right here, because we've got to figure that out. Okay, so they bought merchandise. They did not debit inventory. They debited an account called purchases. That is a temporary account. Okay, it's there. It gets closed out before the financial statements are created. Okay, so they're going to come in here and sell that $820 of stuff. They're not going to make another entry because this is periodic. Okay, this is where it gets a little complicated. And periodic is balancing it out at the end of the year. Okay, so there's going to be a lot right there. So let's take care of two things first. Okay. So what they do, they told us the beginning was 120. So what, I'll just do this really quick. I'll show y'all in the inventory. So inventory had 120 in there. They're crediting that 120 and making it go away, basically. Okay. Making that go away. We know that we had 600,000 of purchases. We're going to debit inventory for 180,000. So we sort of just zeroed that out is really what we did. Okay. Now our ending inventory is 180,000. That will roll over to the beginning of the next year as 180,000. Okay. And we could take that formula, beginning inventory, 120,000, add purchases. We made that entry. I have 1 0, not, I need another 0 there. And that gives us 720,000 goods available for sale. We're going to subtract the ending, and you should get that 540,000. Okay. So they're backing into what cost of goods sold is. This cost of goods sold would be for the entire year for every sale, not just this one sale. If they had a million different sales items, that's the cost of goods sold for that. The problem with periodic is that there's no separation in what was sold, what was stolen, or what was damaged. In perpetual, we know what sold because we made an entry for everything that was sold. So when we do count the inventory at the end of the year, any differences that we find will be theft or damage. Okay, damage, if they know about the damage, they should be making journal entries for that, but anything else should be specifically identified to as theft. Okay, we can't tell that in periodic. We have no idea if it went out the door because we sold it, it went out the door because it was stolen. We don't have any idea. Okay, we just don't keep up with it. Okay, some businesses, it's not worth their time to do a perpetual system or a barcoding system, but for most businesses these days, they do have barcoding systems, so we don't follow periodic. Okay, here we go. I just did this exact same thing. Beginning plus the purchase gave us goods available for sale, subtract out the ending, and we have cost of goods sold of 540,000. Okay, so here's a little comparison to perpetual and periodic. Perpetual, we're always recording either the inventory coming in, inventory going out. Okay, it does provide us a better information. It's more timely. It's easier for your salespeople to look in the system and see how much you have. Okay. It does involve higher record keeping cost, but the technology that has come along makes that cost go way down. Okay. Periodic inventory cost of goods sold are recorded only at the end of the period. Okay. It often requires a physical count. Now, just because we're always keeping up with it over here, we may still be counting it. We may not be counting it once a year like periodic is. It may, this aisle may get counted today, like 2 or 3 aisles. Somebody in inventory control is counting those aisles to make sure they're correct. Okay. And then they're constantly fixing that. But if it got sold, journal entry was made. Okay. So it says requires limited record keeping costs during the period. It does, but it's also really hard to sell things if you don't know what you have. Okay. You can't really look it up in a system. If you've got high volume, you don't, your salesman can't look it up in the inventory to see if you have any of that. They can't sell it, or they're going to have to get it in and, get somebody in purchasing to purchase it. So the perpetual is the more preferred method that a lot of businesses are using. Okay, I'm going to skip those. If you want to pause the video and do those, I'm fine with that. Okay. All right, let's talk about what units are included in inventory. Okay. We're going to talk about FOB shipping point and FOB destination here in just a minute. But just because it's not in our possession does not mean we don't count it. Okay. One good example of that is goods on consignment. We may have goods sitting in a store somewhere else, and we're waiting on those items to be sold. Okay. When the items get sold, it's kind of like the ownership transfers to the consigner, and then immediately to the buyer. Okay, kind of all at once. That's kind of how Frito-Lay and Pepsi do the chips and drinks at Walmart. Like, it's in there. That's why you'll see Pepsi, Frito-Lay workers in their stocking those shelves, because that is technically their inventory. And when that bag of potato chips gets scanned, inventory passes to Walmart instantly, then to the buyer. Okay, so goods on consignment are counted in inventory. They are our inventory. We own them. Okay. Um, Goods that are in transit. Okay. Goods that are in transit. That's very, really important. Okay. I'm going to jump over here really quick. I have got a lot of stuff over here for us to do. But first of all, let's kind of look. My husband used to work at Performance Food Group, so I use this example quite a bit. But we are thinking we are PFG. Okay. PFG orders a lot of chicken from Tyson. Okay. And right here, if title passes right here, they call that FOB shipping point. FOB just means free on board, freight on board. It's more of a legal term. Um, those of you who've had me for legal, I kind of talked about this exact same thing. These are legal terms, and it's very important to understand they're legal terms, but how they apply in our accounting world. Okay. So if it's FOB shipping, that means the buyer, PFG, owns it as it's coming down the road. Okay. So the buyer pays for the shipping. Okay. Then if we have, let's just say title passes right here, FOB destination, then Tyson owned it as it was coming down the interstate. Okay. So the seller pays shipping. And why are these legal terms? Because we want to identify who owns this stuff. It doesn't just like it belongs to somebody as it's going down the interstate, because somebody has to take risk of loss. Okay. Somebody has to take the risk of loss if something happens to it. Okay. So So that's FOB shipping, FOB destination. It could be over here, shipping point or destination. Okay, it works the same way. Um, so keep in mind, if something left Tyson 12/31, title passes right here at the shipping point, and it doesn't get to PFG till, let's say, January the 5th. It does not matter that it's not in their possession yet. It is theirs because title passed right there at the shipping point. PFG owns they have the risk of loss, so they include that in their inventory. Okay. All right. So the other thing dealing with shipping point and all of this, any shipping that is from here to here coming into our business, pretend we're PFG, shipping to get our inventory into the business, that is an inventory cost. Okay. It's inventory cost. It is what they call above the gross profit line. Okay. This shipping out, all of this is called a selling expense. At this point, y'all probably remember doing that multi-step income statement. So this inventory cost, this gets added into inventory over here and eventually ends up in cost of goods sold. That's why they say it's above the gross profit line. It's a selling expense over here on this end, and so that is below the gross profit line. Any shipping we pay going out goes straight to the income statement. Okay. All right. So that'll probably get us through several slides here. Kind of talked about goods in transit, FOB destination, and FOB shipping point. So I'm going to kind of jump on there. I kind of like my little diagram that I always draw out. I talked about goods on consignment. If that's the case, we own those goods. We have legal title to them. we have risk of loss, even though it's sitting in somebody else's building. Okay. All right. Sales returns. Sometimes customers will return things to us. Sometimes they won't return the item to us. The item might be bad. And so we just give them like a sales return or allowance, but we're not going to put it back in our inventory because it might be something that's bad. Okay. But when we have sales returns, we debit the sales returns, credit a refund liability. A lot of times that's usually in accounts payable. Okay. Not accounts payable. Sorry. Accounts receivable. Because if it's customer, we would credit the accounts receivable. Okay. Um, so that's it for this section. I will see you in the next video. In the next video, we're going to do a big example on all of the different inventory methods. I have a handout attached in the Chapter 8 module that you'll see inventory demonstration problem. I can't remember what I called it, but that's what we'll be working on in the next video. So I would suggest you grab that before you start the next one. All right. I'll see y'all in the next video.